Hello and welcome to another episode of Darwin Investors. All right, apparently I'm now an official member of OPEC. I was at a work conference last week and I was talking to a guy who's like, well, he was talking to a crowd. He was like on some soapbox trying to tell everyone there are no new oil fields going up in the United States right now, and that's why the price of oil is so high. And so I couldn't help myself this time, and I had to tell him that that's not true, that the Willow project was just approved several weeks ago, and it's going to be headed up by my number one biggest holding, which is ConocoPhillips, and that's going to be on the North Shore of Alaska. Now, I'm not sure how thrilled he was about my informing him of this in front of everybody, but yeah, now I find myself correcting people on Alaskan oil drilling projects. I'm basically putting the plus in OPEC plus. Oh, well, what are you going to do? All right, so what's on tap for today? So today we're going to talk about a recession, which I believe that we're in right now. We're also going to talk, of course, about the energy market, and then we're going to talk about the sad ousting of number one best prime minister in all the world, Sanna Marin, as she just conceded her election in Finland. Make sure to watch to the end where I give my loving, heartfelt tribute to the best prime minister that has ever walked this earth. And then we'll also briefly discuss the beginning of earnings season. That starts next week. And you know, like when someone, it always kicks off with the banks. And you know, when someone says to you, okay, well, listen, I got some good news and I've got some bad news. Which do you want to hear first? And then invariably we always say, well, okay, just give me the bad news. Well, that's going to be this earnings season. JP Morgan actually does their earnings this Friday. So I think they'll be okay. But some of the regionals are going to be a little bit of trouble. I think one of the regionals that a lot of analysts seem to like is Zion National Bank. And so that might be one that I might take a flyer on, just like a little call option, provided they're cheap, although I don't know if they will be. They're going to be awfully volatile headed into their earnings. But I might throw a couple of call options towards Zion National Bank. But other than that, I'm staying away from those. But I think the big banks should be fine. At least I think they're going to be fine this next week. Who knows? We'll see. All right. So I believe we're already in a recession right now, and that's based on a lot of the economic indicators that we have rolling in right now, such as the Purchasing Managers Index just rolled in last week, also known as the ISM. It came in at 46.3, and that number was the lowest since the COVID lows here. You can see that it's not historically way low. In the last 10 years, it was the only other time it was lower was in COVID. But if you take it back 25 years, you can see it can go way down further. Here it was after the financial crisis, and here it was after the dot-com boom. So 46 is low, though it could obviously trend a whole lot lower. But that's one of the reasons that I believe that we're in a recession right now, because we're not manufacturing any goods. Also, news that came out last week was the ADP private payrolls rose by 145,000 in March, which is well below expectations. They were expecting the estimate to be 210,000. Last month it was 261,000. And ADP payrolls, they say they're private payrolls. And what that is a composite of the top 20% of the non-farm private employment payrolls in the United States. So that seems to be an indicator of what's to come when the Bureau of Labor Statistics puts out their employment report. Also down this month was the JOLTS report. The JOLTS is a job openings report, and it tumbled below 10 million in February for the first time in nearly 10 years. We have 9.93 million open jobs. Now, this is very debatable. Like, they've always measured it this way, but when you put like something on Indeed and you're trying to hire someone, you might advertise in Colorado and Texas and California and Oregon. It's one position, but you've put the advertisement up there 4 times, and this is very common for people to do. Take this number with a grain of salt, but in any case, it was a drop of 632,000 from January, and it was the first time that vacancies fell below 10 million since 2021. And this is indicating that the labor market seems to be weakening. So we've got a weaker ADP, we've got weaker manufacturing, we've got weaker job openings. And we also have the employment report that came out yesterday. The growth totals were 236,000 in March. The hiring pace has slowed. The street was expecting 238,000. So it came out in line, a little bit lower than what was expected. And it was way below what was the 326,000 in February. Of note in this report, we can see that the unemployment rate did go lower to 3.5%. The Fed might see that as bad. However, the hourly earnings rose 0.3%, pushing the 12-month increase to 4.2%, which is the lowest level since 2021. So job openings are down, hiring is down, wage increases are down, and just a whole lot of negative economic data that is rolling down the pipeline right now. We also have this that came out this past week, which is the initial jobless claims. And then they had a downward revision last month. As a matter of fact, they not only downwardly revised last month, they did for the last few months. And you can see right here, this is the year of 2023, and this is the zoom in on that year. What is right down here was the initial jobless claims. Initial jobless claims that are lower would be considered like stronger for the economy, and higher jobless claims would be considered weaker for the economy. And you can see that the red line here is where they've all been revised upward. So last week's claims came in at 246,000, which is massively revised from 198,000. The week before that was 247, revised from 191, and the week before that was 230, revised from 192. So there have been a whole series of upward revisions showing that the labor market's got a lot more cracks and a lot more problems than what the Fed chooses to acknowledge. In addition to that, what the Fed is also raising interest rates on is on rent growth. And this is the services data. And this came from Barry Sternlicht of Starwood Properties. He manages 123,000. He's a billionaire that manages 123,000 properties. And what he's showing is that when you look at the Bureau of Labor Statistics and they show that CPI data, what they're showing is right here that the CPI in shelter just keeps going up, 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 up. But what's actually happening is the rent is coming down, 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 down. And the Fed is raising rates based on this number here, because what they do is they look at past data. They don't reflect forward. They're not forward looking. And so even when the data was going, skyrocket up here, was going up a little here, but it's going way up here, they were still buying back mortgage-backed securities. And remember, they were giving everybody just like extra $700 a month in unemployment checks, and they were buying back $120 billion a month of mortgage-backed securities and treasuries. And they created a lot of this inflation, and they continued to screw up on the way down as well. So we all know that oil was way up last year. It was up around $120 a barrel. It won't be anywhere near that this summer, so we would expect that the cost of energy wouldn't be much cheaper this year. We also know that the cost of housing is eventually going to roll over. Even Jerome Powell knows that to be true. And because of that, they've created what's called the super core. And what the super core is, it's the Fed's focus on an even narrow set of prices, which further strips away the housing component from the inflation rate. By stripping out the housing component, when it starts to come back down, that's going to still continue to allow them to raise interest rates until the unemployment rate meets their liking. They're basically just really botching this up. They're going to be nobody's friend here really soon. And again, I do not like the Fed. Despite all of this data, and you might give, say, Jerome Powell a pass for maybe he didn't have all this data. He certainly didn't have all the data all the revisions that came last week from the initial jobless claims, or maybe the new JOLTS data, or the new employment data, but she did. And so she says that she still wants to move interest rates higher despite having all this data. This is Loretta Mester. She's with the Cleveland Fed. She just wants to keep on hiking up rates. And again, this is not going to do anything to inflation. All this is going to do is hurt our banks. And for Jerome Powell's end, I mean, this is a transcript from the last FOMC meeting, and I just find this shocking that this is how flippant they are with the American economy and with jobs and the way that they think of people. So this was a reporter that asked, but I guess the question is, historically, it's been hard to contain unemployment. And the question is, do you worry about some sort of snowball effect? And how do you factor that into your projections and your thoughts? Like basically you said, once the unemployment rate starts going, how do you stop it? But it does tend to fall off a cliff, which in this case, the unemployment rate goes straight up. And here's Powell's response, and this is really quite shocking how they're doing it and they're blind and they're like, screw it, we're going to do it. Well, it depends on whether you. So recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's what. So we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down because we know in the longer run, that is the thing that will be most benefit the people we serve. That's how we can have a long, we've had very strong labor markets through these long expansions that we've had. And just going on, well, we don't really know. And, inflation and we don't know what's going to happen to labor. And for this reason, the stock market and the bond market seem to be in pretty rare agreement. So if you look at the S&P 500 over the past 5 days, it's actually up 1.2%, and that was despite getting all of this really negative data. And Loretta Mester coming out saying, and Mark and James Bullard too, we're going to raise rates. We're going to keep on hiking, hiking, hiking. And so the S&P 500 didn't believe that. The bond market doesn't seem to believe it. You can see that it started the week at 3.47, ended up the week at 3.41, and this would be the 10-year. So the 10-year came down. The 2-year, it started the week at just over 4% here, 4.0%, and it ended the week at 3.99%. It didn't move much. So the stock market doesn't really believe the Fed anymore, and the bond market doesn't believe the Fed anymore. In addition to that, the oil market, it also didn't go up. Oil market itself was very steady, even in the face of these OPEC plus cuts. And that's because with the recession that I believe we're in, or that some believe that it's coming, the price of oil tends to come down. And the oil stocks this week earlier did actually go straight up because apparently this was a surprise to some people. In a surprise, OPEC Plus announces cut in oil production. And what this was a response to short sellers that were selling, they were basically short selling oil, and it made the OPEC folks mad. So they cut supply and kind of squeezed it. Not only squeezing them, they squeezed my own portfolio because I was selling covered calls on ConocoPhillips and Chevron, Marathon Petroleum, and Phillips 66. I actually came out okay on Marathon Petroleum and Phillips 66, but not so much on ConocoPhillips and Chevron. I'll show you that when I show into my portfolio. But I guess this was a surprise to everyone but one person. Saudi Arabia and Russia in a meeting on Thursday affirmed their commitment to OPEC Plus decision last October to cut production by 2 million barrels per day until the end of 2023. And OPEC Plus is due to meet on April 3rd, which they're going to do what? If the price of oil is crashing, I imagine they're going to be cutting more production targets. And that's going to send oil up a little bit. All right, so I do believe that we're in a recession right now. And up to now, the video has been pretty negative, but that's not what this channel is. What we want to try and do is where can we go out and find that money? And in recessionary times, you want to look at possibly utilities, healthcare, and consumer staples. You want to stay away from industrials, discretionary, and tech, and things of that nature. If you're in unprofitable tech right now and you're up, this might not be a bad time to go ahead and cash out some of your winnings and maybe rotate into something else. And plus, this is a rotational time of year anyway. I think April through the summertime rotates from growth into something else. And a lot of times it is those sectors that we just discussed a second ago, utilities, healthcare, and staples. I actually still like energy a whole lot. It trades at a very reasonable valuation to the S&P, and they tend to have very nice dividends. If people want to get into, say, short-term treasuries and money market funds, you'd certainly get no hate out of me. I just don't like tying up my money that way. I would rather go into something that's a safe type of value stock and just sell calls on it and try and make a little bit of money that way. I do wish the Fed were kind of more innovative. I don't like that they feel like that in order to fix things, they need to destroy it. I don't see the logic. Perhaps they could come up with a different way, or at least look at forward data. The things that we can all see, I wish they could see it as well. But it is what it is. And so for myself, I like energy, but there's also somebody else that likes energy, and that's Leon Cooperman. So Leon Cooperman is bullish on oil and has 20% of his portfolio in energy stocks right now, and that was as of April 3rd. The stocks that he tends to like right now, I think he had a couple of really good suggestions, or at least ones that I think that are worth looking into. The widely followed investor said his two favorite stocks in the sector are Canadian oil and gas producers Paramount Resources and Tourmaline Oil. We'll go ahead and have a look at a couple of those in just a second. In addition to Leon Cooperman's picks, we also might have a look at, or at least talk about the list from here, the 7 best energy stocks to buy now. This was updated on the 3rd of April, which was last Monday. Seventh on this list was going to be Schlumberger. This is a company they're trading around $52 a share. The target is $66. It's one I've owned in the past. I like this stock, but there are others that I like more. I do own Phillips 66. I really like this stock. This is an oil refiner, not an oil producer or oil exploration stock. And what I think is interesting about these refiners is that when the price of crude oil goes up, these have a tendency to go down and vice versa. That's because their input costs go up if the price of crude goes up. So they seem to run inverse or in reverse of the price of oil sometimes. They sometimes go with it, but they do sometimes run in reverse of it as well. And so it's not bad to barbell your own oil portfolio with some of these producers because they will kind of make up some of your losses if you're in stuff such as Exxon and Chevron and things of that nature. Another oil exploration and production company is Pioneer. That's on this list as a moderate buy. Another one on this list I've never actually looked into is this EOG Resources. It's also engaged in exploration, development, production, and marketing of crude oil, natural gas, and natural gas liquids. This one seems to be kind of well diversified. It's called a strong buy. That might be one that I'm going to be looking into in the future. My biggest position is right here. That's ConocoPhillips. It's called a strong buy. I like it because it has a price to earnings ratio of roughly 7 and a dividend of 5%. I feel like I can't go wrong with this one. I really do like ConocoPhillips. Next on this list is Valero. Just like Phillips 66, this is also another oil refiner. I don't own Valero, but I do own Marathon Petroleum. That's not on this list. And the top of this list is going to be Cheniere, and they're an exporter of liquefied natural gas in the U.S. And you say, why would you want to own Cheniere if natural gas is getting clobbered? Well, natural gas might be going down the tubes. However, it still costs money to transport that natural gas, and that price seems to be holding pretty steady. Now let's go ahead and have a look at some of those stocks that Leon Cooperman was suggesting. One was this Paramount Resources that's currently trading for $22.86 a share. Year to date, it's up almost 21%. Over the course of a year, it's a little bit down. It's down 2.79%. However, over 3 years, it's up 178%. It trades at a very fair price to earnings ratio of 6.71 and a forward P of 8.23, which is a significant discount to the S&P 500. It doesn't announce its earnings until the 3rd of May, so you got a little bit of time before it gets incredibly volatile. The annual dividend is 4.84% and it's dispersed monthly. So it trades with a very high dividend that gets dispersed monthly in a very low price to earnings ratio. The stock is only $22.86 a share. This looks like a really attractive buy to me. I think Paramount Resources is a real winner. This Tourmaline for me is just a little bit of a different one. I don't know that I find this one to be quite as attractive as this Paramount suggestion. Over the course of 3 years, however, it is up 441%, which is awful nice. Over the course of 1 year, it's down 7.36%, and year to date, it's down 10.64%. It trades at a price to earnings ratio of 4.3, which is very solid, and forward PE of 7.8. Indicating it should shrink a little bit this year, which is to be understandable because the price of oil will not be $120 a barrel this year. It has a pretty small annual dividend yield of 1.76%. This dispersed quarterly. Again, it's not one that I like as much as Paramount, nor is it one that I like as much as ConocoPhillips over here. ConocoPhillips, like I said, is my biggest position. Year to date, it's down 6%. Over the course of 1 year, it's up 3.1%. And over the course of 3 years, it's up 197%. It trades at a price to earnings ratio of 7.3 with a forward PE of 10.5. So it's not trading quite as cheaply as Paramount is. However, However, its dividend's a little bit bigger at 5.03, although I don't think you'd know the difference between 4.84 and 5.03. So I'd say I'd call that a wash. It trades quarterly. Overall, like I'll be honest, I really like the Paramount even a little bit more than Conoco, and Conoco had been my favorite one to this point. Now let's go ahead and switch gears a little bit and talk about other things that are coming up. One that I've got right now holding is going to be Schwab. I got that put to me. I sold a put on that last week, and I got that put to me, and so I have it right now for $50.90 a share. They're going to actually have their earnings on the 17th of April. That's not this Monday, but it's the Monday after. So they're going to be one of the first companies that report earnings. I know that this company has multiple revenue sources. It's not just a retail bank, but it's also a trading bank. And so every time I sell a call, they collect 65 cents and stuff like that. So they got another revenue stream that they can tap into. They have a price to earnings ratio of 14 with a forward PE of 13. They're the 10th biggest bank in America. I do think that they're actually going to come out of the earnings a winner. I'm not going to sell a call on this stock right now because I believe that that I think it's going to go up significantly on earnings. If it goes up like $58, $59, I'll go ahead and sell out of my position. JP Morgan is going to release earnings this Friday. It's on the 14th of April. They traded a reasonable price to earnings ratio of 10.5 with a forward PE of 10. Again, I think they're going to be okay on this. They have a nice dividend yield of 3.14%. And I think this is going to be one that's actually going to do okay on earnings. It's not one that I would be really scared about. One that I think is an interesting play these days is Oracle. You can see that Oracle keeps on going straight up, right? It's sitting here at $95.92. And one of the reasons why Oracle is going up right now is it goes all the way back to the TikTok deal. So TikTok moved all of its US traffic to Oracle servers. And so the thought is that if TikTok is forced to sell to a United States company, the company they're actually going to sell to is Oracle. And for this reason, Oracle's has been charging up. If you look at it here year to date, it's made a pretty nice rise of about 15%. And particularly since these the TikTok hearings have been going on, it's moved from about $83 up to about $95. And so that's the reason why people are kind of like crowding into Oracle right now. It trades at a price to earning ratio of 31.5 with a forward P of 19. So it's not a cheap stock. It does have a small dividend of 1.67%, but again, it's the TikTok acquisition or merger that has people excited about Oracle. USOI has also announced their dividend. Now, in my opinion, USOI, this might be a really nice time to get out of this stock. They just announced their dividend. They cut it all the way back to 60 cents. The ex date is the 19th of April, and the pay date is the 25th of April. For right now, the annual distribution yield is a ridiculous 44.43% that's paid out monthly. However, I do think with Credit Suisse going under or being bought out by UBS, that maybe this dividend payment might be one to just kind of keep an eye on, as it might not be quite as good as it used to be. So this would be one that if you've made profits, you might want to consider getting out of this one and going back into it when you got some more clarity over what this dividend is going to be like. And finally, one that I think might be a pretty neat ETF to get into, at least to have a look at, just to have a look at for an idea of stuff to maybe get into. This is the seasonal rotational ETF called SZNE. It trades for $36 a share. And what this does is they like to rotate as the season goes. Remember, I told you that here in April through the end of summer, how there likes to be a rotation. Well, this ETF kind of does it for you. 1 year it's down. Well, 1 year we'll call it break even. 3 years it's up 47%, and over 5 years it's up 42%. If we compare this ETF to the S&P 500, you can see if you just bought the S&P 500, you'd be up 12% relative to this one. But what I think is interesting about the seasonal ETF is that you can actually go into their holdings and have a look at the sort of things that they're buying as this as their seasonal right now. This ETF has 221 holdings, so it's basically the S&P, well, like half of the S&P 500. Their top holdings right now is Newmont, and then International Flavors, Freeport McMoran, Packaging Corporation, Martin Marietta, LyondellBasell, Armor PLC, Linde PLC, PPG, and Ball. They tend to like the minerals and mining right now, and chemical stocks. If we look at their next 10 matches, we can see more of the same. More chemical stocks is pretty much the big one, and commodities. Looks like fertilizer and construction materials. And so this is the sort of thing that they're getting into right now. It might not be a bad idea if you just want some ideas about what to rotate into seasonally. Look at the SZNE ETF, and that might give you an idea of what you might want to have a look at least to give you some ideas of what you might want to put some money into. And finally, we'll have a really quick look at my options portfolio. I wanted to go into this in more depth on this video, but we're kind of running out of time here. You can see that I have, 5 calls open, one against Chevron, one against Phillips 66, one against Marathon Petroleum, 2 with ConocoPhillips. I stand to make $1,138 if all goes well by the 14th of April. I'm currently up $452 on these positions. Like I said, I was assigned Charles Schwab yesterday, and I'm all right with that. You can see from the cost basis here that it's never an even number, and that's because Charles Schwab takes a little piece of every option that's sold or bought, and they also own TD Ameritrade, and they collect money on every option bought or sold on that platform, and that is a trading platform. So they do have multiple revenue streams. I really would like to go in this a little bit more, maybe for another video. I tend to stay away from stuff like this because I want it to be less about me, unless if there's something that I can give, like by showing my portfolio, if I can give some sort of like lesson or something good for viewers, I'll go into it a little bit more. But right now, I'll just show you that that's what I have right now, and maybe another day I'll go into it a little bit deeper. All right, well, that's going to do it for this week. If you got anything in this video, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye. And now, a very sad word from my sponsor. Guys, has your favorite politician ever lost an election and you're not quite sure if maybe they counted the votes wrong, and you're afraid that your life has been turned upside down and nothing will ever be the same again? Man, I have. And for those days, I like to wash it all away with my sponsor this week, which is beer. Hold on a minute. It's still delicious. It's gonna be okay. Life goes on. My sponsor this week is Dogfish Head 60-Minute IPA, and I have no choice but to give this beer 5 Sanna Marins out of 5. Have a great week, everyone. Bye.